The Indian equity markets have had a slightly rough week, with the benchmark indices correcting by about 2.5% over the last week. Now, at times like these, we often come across sensational news articles like this one or this one. But the fact remains that if we are looking at the markets with the intent of investing only for a week, then yes, the markets have definitely corrected. But I'm sure neither you nor I are investing for a week or even a month. We are here to invest in good quality businesses which can give us sustained returns in the long run. So we can sit back, relax, and ignore sensational news like the ones that we just showed you. Having said that, we do need to be mindful and we do need to be aware of what are the factors affecting the markets currently and whether we should really be worried about them or not. But that's exactly where we have got you covered. From updates on the US GDP data to how the US bond yields are affecting the global markets, we have covered it all in today's episode. Additionally, we have our in-house experts who will throw some light on the Israel-Palestine crisis, its impact on the global as well as the Indian markets, and how you and I as investors should be acting during these times. So sit back, relax, grab a cup of tea or coffee, whatever you prefer, and enjoy this episode of The Third Umpire as we simplify all of it for you and also help you become well-rounded investors. You're watching Informed Investor, The Third Umpire, an initiative by Research and Ranking. Let's begin. Now on Monday, which is the 23rd of October, the yield on a 10-year government bond in the US, which serves as a benchmark for asset prices globally, surged to 5.02%, marking its highest level since July 2007. Now this of course made headlines globally and within India as well. Now this sharp and unusually large rise alongside others has sent shockwaves through financial markets, leaving investors puzzled over how long rates can remain at such high levels. Now, before delving into the reasons behind this significant rise in the bond yields, let's first take a moment to understand the basics of the bond market, so to say. Now, what exactly are bonds? Now, a bond is a fixed income instrument that essentially represents a loan made by an investor to a borrower. Now, these borrowers can be either corporations or government entities, anybody. Now, in the case of corporations, much like how they offer shares of their ownership to investors through stocks, they also raise capital by issuing debt in the form of bonds. Now, bonds essentially represent units of debt issued by companies, and they are bought and sold in a manner similar to stocks. Now, what exactly are bond yields, you may ask? Now, bond yields represent the returns that you receive as a bond holder from purchasing the bond in the secondary market. Now, like any other asset in the secondary market, they are influenced by the forces of demand and supply. Now, bond yields have an inverse relationship with bond prices. For instance, consider a bond with a 5-year maturity, which has a 5% coupon rate or the interest rate, and which has a face value of rupees 10,000. Now, this bond pays you 500 rupees in interest every year. Now, however, if the interest within the market rate or the interest rates within the market rise above 5%, then the new bonds which get issued then with higher rates become more attractive to investors. Now, to compete, the price of the current bond will have to be lowered, which increases the bond's yield as the coupon rate rises due to the lower face value. Now, this process illustrates how bond yields fluctuate based on prevailing market interest rates. Now, in general, bond yields and bond prices move inversely. When bond prices go up, yields go down, and vice versa. So why exactly are bond yields rising? Let's discuss why US bonds yields are rising this time. Now, the increase in the US bond yields can be attributed to several factors. The first is the Federal Reserve's interest rates. Now, the bond yields are highly influenced by the monetary policy of the Federal Reserve. As the Fed raises interest rates in response to economic conditions, bond yields tend to rise in tandem. Now, the Federal Reserve's commitment to gradually increase the rates with the aim of achieving a soft landing and a 2% inflation target has contributed to the expectations of further rate hikes, which push up the bond yields. economic growth and labor market conditions. Now, US is experiencing better than expected job figures and consumer spending data, which is a welcome news for the economy. But it makes the Fed's role of slowing inflation a lot more trickier. Now, US Fed Chair Mr. Jerome Powell recently remarked and highlighted the importance of below trend growth and the softening labor market conditions for achieving the 2% inflation target. Any evidence of persistently above trend growth or labor market tightness not easing could lead to further tightening of the monetary policy, leading to higher bond yields. Now, other factors are factors beyond the Federal Reserve's actions, which play a very crucial role. Now, concerns such as the spike in oil prices and heightened geopolitical tensions, which is the Israel-Hamas crisis, can lead investors to seek higher returns, which can affect bond yields as well. Now, the increased bond supply is also a factor. Now, the surge in the supply of bonds in the recent quarters due to high deficit in the US government has also put upward pressure on the yields. When the government borrows more money, investors typically demand higher yields as compensation for lending their capital. As a result, we find ourselves in a situation where it's becoming increasingly unlikely that we'll see any rate cuts in the near future. Instead, the prevailing trend suggests that further rise in interest rates cannot be ruled out just yet. Now, this anticipation of rising interest rates is prompting investors to sell the bonds that they currently hold. Now, they do this to limit the potential capital losses associated with an increase in interest rates, which tend to lead to a decrease in the market value of the existing bonds. Now, in summary, the current rise in the US bond yields reflects expectations of higher interest rates. Investors are responding by selling existing bonds to mitigate potential losses, as rising interest rates tend to lead to declining bond prices of the existing bonds. All of these factors lead to FPI outflows. Now, when US Treasury bonds offer higher yields, it becomes more attractive to foreign investors, including the foreign portfolio investors. Now, they are drawn to the potential for better returns on their investments. Now, as a result, the FPIs often shift their funds from emerging markets like India to the US. Now, this trend has led to a significant outflow of foreign capital from Indian equities, as seen in the substantial 9,935 crores worth of stocks sold in the month of October 2023 alone. However, it's important to note that FPIs have remained net buyers of Indian equities throughout the year, and this reflects their ongoing interest in the Indian market. Now, the outflow of foreign funds driven by FPIs moving their investments to higher yielding US assets puts a lot of downward pressure on the Indian rupee's exchange rate against the US dollar. Now, a depreciating rupee can contribute to negative sentiment in the Indian stock market, as it may increase the cost of imports and impact various sectors. Now, despite these short-term challenges, several factors work in India's favor. While the surge in the US bond yields has led to FPI outflows and rupee depreciation, India's resilient macroeconomics, festive season boost, and domestic institutional investor support are factors that can help the Indian stock market weather the challenges and potentially withstand the surge in the US yields better than many other emerging markets. Now, recently, the Bureau of Economic Analysis released the GDP data for the US, and it shows a very promising Q3 for the US economy. Despite ongoing high inflation and global headwinds, the US economy grew at its fastest pace in nearly 2 years on the back of strong consumer spending. The US GDP for the third quarter of 2023 came in at an impressive 4.9%, which is more than double from the previous quarter's reading of 2.1% on the back of several factors. Now, economists had polled by Reuters, they had forecasted GDP rising at a 4.3% rate. Now, when looking at the breakup, the highlight was on personal consumption or consumer spending, which rose by 4% from the earlier reading of 0.8% in spite of higher interest rates and high inflation as well. Now, this indicates higher wages from a tight labor market that supported spending at the consumer level, which was split fairly between goods and services, with the two measures up 4.8% and 3.6% respectively. Consumer spending, which accounts for more than 2/3 of the US economic activity, was the main driver. Apart from this, increased exports rose over 6%, residential investing rose by 3.9%, government spending surged by 4.6%, and all of these were the other drivers for the impressive growth in the third quarter for US's GDP. Imports, which are a subtraction in the calculation of the GDP, also rose by 5.7%. Now, this impressive growth of 4.9% for the third quarter of 2023 comes in at a time when many economists had thought that the US was in the midst of a recession. Now, amid high interest rates to tackle the ongoing inflation of 3.7% for the month of September 2023, consumer spending rising indicates a strong labor market and a positive trend in the economy, giving the Federal Reserve the hopes to provide a soft landing for the economy. Now, with the FOMC meet scheduled in the following week, it will be very interesting to witness the stance of the committee as inflation still hovers above the tolerance band of 2%, with interest rates currently at 5.5%, which is the highest in the last 22 years. Now, while we've covered and spoken about the updates from the US, let's look at an excerpt from what our in-house experts, Mr. Jaspreet Singh and Mr. Sanjeev Anand, have to share about the ongoing Israel-Palestine conflict and what we should be doing as investors during these uncertain times.
Namaste to everyone. It's been an overwhelming response from everyone who's participated in this given Ask Experts session. The topic is such that these are the questions that most of you asked us, and we thought that without being biased, we will present the facts to you, the data to you, and in doing so, we will spell what you should be doing, because the title of the invite that was sent to you said, it's time to panic. Of course, it is time to panic, because there are certain things that are happening which you should take cognizance of. There are certain downturns in the market that we are going to discuss right now, and of course, Jaspreet would also take you through some of the bits of what all this means to each and every one of us as investors. But more importantly, you're joining this given Ask the Expert session because you wanted answers to your own questions. And your own questions are the most important aspects of what we will do today. And we will be spending more time in answering your questions than in presenting whatever that you want to present. So we will read out the questions, we'll read out the people who sent the questions to us, and we'll attempt answering those questions for all of us. All right. So let's begin. We've seen the downturn in the Indian markets, and for sure, if my memory jogs me back, it was the 9th of this given month when something startling happened. And what happened was, this is the recent turn of events where the markets have corrected by over 4 to 5%. And there was a phase from Monday onwards till about Thursday when every single day when you woke up, you saw the market was declining. There was a 1%, a 1.5%, a 0.4% decline on the markets as such. And this is after you'd see the markets go to heights of about 19,000. In fact, there was a period when the markets on the 15th of September had touched 20,000. And before this event happened, the markets were poised at about 19,800. But what happened that these markets corrected so much? If you go by the turn of events, right? The next slide. If you go by the turn of events, it was the unfortunate but the true war-like situation. In fact, a war that started between Israel and Hamas. Hamas is a more radical outfit of a arm from a Gaza perspective, which takes that agenda forward, the agenda of having to see Palestine increase its presence within the continent, and of course this is a fight that is not begun now. It started all the way back in 1917, and since 1917 of where we are as of now, this is perhaps one of the most full-blooded blows from both the sides. It so happened that it's claimed that Iran was involved in planning the attack from the Hamas part to the Israeli territory. There were people partying all night, and early in the morning there were people who were shot, and surprisingly so, there were people who came in power gliders and did this. But what came in retaliation from Israel was nothing less than declaring a full state war, and this is what has caused the conflict to spread beyond the bounds of a regular spurt that we've had in the past. While the PowerPoint presentation. So while the presentation is mounting again, but what you have to keep in mind is the repercussions of what this war means. The repercussions of what this war basically meant is that you have a phase where Iran or other Muslim Mamalik, as we say in Hindi, have also lent their support to the Palestinian cause and have expressed their full-fledged support to Hamas. And this is what is now turning into a polarized world where the Western powers are either with or without the full support to Israel. And if we really see the conflicts of what it means to every investor out there, then the next slide sums it up, where it, in fact, slide number 7, if I want Rahul to come on that, because this is the main concern. If Iran gets involved and the oil prices, the next slide, please. If Iran basically gets involved and the oil supply is stinted or is not given in full blow to the people, then a lot of people who are dependent on imports of crude will feel the heat of it. India imports about close to 85% of this, and this is where the real issue is. Now, one of the important things that you have to remember is that it's not exactly the war that causes the corrections in the markets, but it's more the volatility or the fears associated with the rumor mongering that go on that create the ripples otherwise. So in this given sense, it is true that it's an unfortunate situation, but it's led to a point where lots of people, lots of emerging markets are now reeling the pressure of higher import bills, and these import bills ultimately will have an effect on downstream on their profitability, on their margins that ultimately will be displayed for the given quarter. If you go by the next slide, there is also a sentiment risk that is prevailing at this given point in time, because as much of a flux that you see in the equities market, especially with the emerging markets context of it, FIIs or FPIs, especially FIIs, will make sure that their money from a more volatile and a chaotic environment ultimately goes to a more safer place. What is a safer place? The safer place is, of course, the bonds that are being now offered from the US sovereign state. And if you go by the slides, Rahul, this is what I was intending to tell you, that there has been a recent surge in the bond yields in the US. इसका मतलब क्या होता है? How do you relate to what is happening? Now, these are risk-free assured asset classes, right? So risk-free assured asset class of a US sovereign state is offering you करीबन 5% interest on a 10-year bond yield. Now, this is for sure something that is happening that you will get as a return. Why would you risk your money in an emerging market equity sort of a setup where you don't know what the next morning's dice reading would be? Whereas back home, you're getting a 5% interest. So this is also one of the reasons that people are taking a flight to safer havens. And if you go by the flow of the FIIs or FPIs ka dekhiye, close to about 20,000 crores, and this was updated as recent as yesterday by the Informed Investor team. As much as 20,000 crores has seen an outflow since the 1st of October, which is a significant amount. But for the year that we are considering, it is still in a positive territory, in a pretty decent one. It's about 1 lakh crore. And similar is the stance if you see for FPIs as such, where 2023 happens to be a decent year in comparison to what it was in the earlier norms. 2022, of course, was a major disappointment. And this is something that is what you've expressed in your questions to us. Most of you have come back to us and saying कि ये जो Hamas का war चल रहा है, ये जो escalating conditions नजर आ रही हैं, do we need to panic? In one given aspect of it, yes, you need to panic, and we'll come to the point of why you need to panic. And what are the reasons? The reasons are crude, which has reached about $89 to $90 a barrel. It is the outflows of the FPIs. It is the outflows of the FIIs that are happening in the markets as such, right? So there are reasons. And this is where I'll take a pause. We will answer all your questions. Those are more important. But we will then request Jaspreet to take the section 2, that this is the more, let's say, confusing or the more worrying part of the equation, aaj ki date mein. But what are the facts saying? What is the data saying? What are the prospects saying? Should you really panic? Over to Jaspreet.
Yeah, hi. Good morning, everyone. Can Sanjeev, can you confirm if I'm visible and audible?
Loud and clear and beautiful as ever, Jasprit.
Okay, great. Thanks. तो हमारे एयर कमांडर साहब जो हैं वो एयर टावर होता है ना हर सिटी में, तो उन्होंने बोला भाई फ्लाइट को डाइवर्ट करो, इजराइल की बहुत हो गया, इजराइल इंडिया पे वापस आओ, तो हम फ्लाइट को इंडिया वापस लेके जाते हैं. Why India still seems to be that lotus in that pond which seems to be muddy, and उससे घबराना नहीं है, right? हमें तो बस हमारे लोटस पे फोकस करना है, right? So friends, what we can see on the screen is actually the fact that our markets have risen irrespective of events, which means global political events, warlike events, macroeconomic events, and also the recent, let's say, the COVID type events, and now again a warlike thing is we've come out of it, almost come out of it, jo hua between Russia and Ukraine, and now it's again around this. So the markets have gone up a very ballpark in the range of 12 to 14% CAGR in the last 5, 10, 15, 20 years. And that is a larger number we look at, and our request is all our people who have joined us today should also be focusing on, right, कि on a rolling basis क्या हर 5 साल में market 12% minimum up to 14% CAGR दे सकता है, 12 to 14%? If the answer is yes, and that's a fact, right? This is not a number that we have just taking out of air, we are estimating. It's just the last history. The next 5, 10, 15, 20 years, the numbers can only get better and no less. Can you move to the next slide? Yes, so this is also something similar. Irrespective of the events, the resilience of the Indian economy is also equally strong. So 11.2% CAGR से इकोनॉमी ने ग्रो किया है. 11.2% CAGR. This is nominal GDP, right? हमारी जो GDP, almost all of you know that, but just for the larger forum, the GDP that we see is net of inflation, so that's about 6.5-7%. This is gross 11.2%. Ballpark इसी के आसपास companies grow their revenues, right? The larger ones, the mid caps ones grow, right, 15-16%, and the small cap companies tend to grow 20% if the economy is growing at 11.5-12% nominal CAGR. So even now, the next 5 year, if I were to talk about 5 to 10 years, ballpark 6.5 on a real GDP basis, real growth. On a nominal growth, it should be closer to anywhere between 11 and 12%, depending on year to year. So again, the same data. Next slide, please. Yeah, so this is something that S&P recently said, but in fact, उन्होंने तो ये बोला था कि that we're gonna be the third largest by 2030. But I disagree with that, and disagree. I mean, not only me. I mean, I'm not the ones. I'm not that in that. But what I mean by that is हमारी खुद की calculation और IMF की calculation और बाकी कई सारे experts की calculation बताता है कि हम 2027 में we would reach there, which is 26 or most latest by 2027, right? Not 2030. So the way we are growing, we would dislodge Germany and Japan latest by 2027 and be the third largest economy. They had their own calculation, but this is what. But anyway, so the larger point is 2027 में once India becomes the third largest economy in the world, the amount of flows that we can get from the FI desk, and these flows would be different from the current flows, right? अभी भी हमें flows मिल रहे हैं FIs के, right? But it is said that 85% or more of the flows that we get are global flows, right? They are Asia flows. They are emerging market flows, right? तो एशिया में अगर कोई का फंड अगर फ्लो डालता है, उसका एक छोटा सा टुकड़ा इंडिया में आता है. इमर्जिंग मार्केट में अगर कोई पैसा डालता है, उसका एक छोटा सा टुकड़ा इंडिया में आता है, राइट? अभी emerging market with India focused or pure India focused funds utne nahi aa rahe hain. That's going to trigger once we reach to that scale, because nobody can afford to ignore the third largest economy in the world. in 2027 and not have a India dedicated fund, right? तो वो एक बहुत बड़ा that's going to be like a big jump in terms of liquidity as well. Next, please. These are again, the IMF projections, which suggest that our economy and the growth rates, and similarly the other large economies in the world, how are they expected to grow? And you can clearly see the India chart. I'll request to focus on the last bar, which is the blue and the orange bar, and the blue and the orange bar at 6.3%. This, I believe, is the calendar year. Is standing tall as compared to all other nations in the world. और ये friends, obvious question है, तो क्या हुआ, मतलब एक साल तो हम grow कर ही सकते हैं, right? My sense is, my humble view is, this is gonna be the case for the next 5 to 10 years, right? That our GDP growth rate is gonna stand out tall, the highest, at the highest, every year after year, when compared to all other large economies in the world. उसमें कोई please Philippines या कोई एक Scandinavian countries हो सकती हैं जिनका एक साल में ज्यादा हो, but then they compare to a Bombay and a Delhi, right? तो मतलब उसके मुकाबले है तो उतनी उसकी पॉपुलेशन होगी, राइट? तो इसलिए वो हमें उतना ज्यादा फर्क नहीं पड़ता है. फ्रॉम द लार्ज टॉप, लेट्स से 25-30 nations in the world, we gonna stand tall year after year, not only the next 2 years, and that's gonna वो डेल्टा ही हमें वो थर्ड लार्जेस्ट पे लेके जाने वाला है. नेक्स्ट प्लीज. Yeah, so again, post these events, what this slide clearly says that after the attacks, the 9/11 attacks, the GFC, even demon earlier, even post that, the CAGR, agar, if you look at the CAGR, it's on the lower side, it's been 13.5%. On a higher side, it's been about 17%. So again, very ballpark. This is the larger CAGR that's the market has given post that crisis. And friends, again, we are looking at Nifty. The moment you do a weighted average of Nifty mid cap, Nifty small cap, this number would be slightly higher. The moment you add alpha to it, which is something that we as at Research and Ranking proudly claim that we are there in the business of making alpha, this number should be even higher than that. Next, please. Yeah, so I guess this was covered, but it's more like a conclusion that we need not fret, we need not get scared from what's happening. As Sanjeev explained, inflation thoda bahut impact hoga. Oil prices, because that's the single largest factor which could disrupt inflation, which could disrupt because the oil prices going up, वही उतना बड़ा impact है. Otherwise, long-term investors के लिए, they have to use this crisis as an opportunity, and every correction you should see as an entry point. In fact, yesterday's market is kind of giving us that signal that smart money came and bought yesterday, right? After I think almost 3 or 4 days of 3 days of correction. So there was अच्छे क्वालिटी नेम्स में कल रीजनेबल अमाउंट ऑफ बाइंग थी, एंड दे वर अप बिटवीन 5-7-8%. उससे भी काफी कंफर्ट मिलता है कि यस, द स्मार्ट मनी इज कमिंग बैक एंड देयर इज नो रीजन व्हाई वी शुड गेट स्केर्ड. नेक्स्ट प्लीज. यस, व्हाट अबाउट वैल्यूएशन? बाकी सारी बातें तो अच्छी हो गई, बट अभी वैल्यूएशन पे आते हैं कि भाई कितने पैसे देने हैं फॉर द काइंड ऑफ वैल्यू फॉर मनी क्या है. सो करंट ईयर the PE seems to be about 20 times, which is probably at par, but obviously nobody is buying the market basis current year earnings. Next year earnings पे देखेंगे तो it's about 17.5 times, while the growth is going to be close to about 13-14%. Nifty EPS, so March 25, PE 17.5 seems attractive given the fact that as we said, we are amongst the large economies in the world, which is growing at 6.5% plus minus. Long-term P average ranges in the would be closer to be about 19, 20, 21, 22 times. So there is at least a 10% upside available, at least is what I'm saying, which is what is visible in that 20x upside, right? And if you look at even higher, because there is no reason why we cannot get re-rated year after year. See, very, very simply, the size of the economy today, the way it's going to grow, the position we are going to be at in 3 years or 4 years from now, the improving ROE trend of corporate India, right? The deleveraged balance sheets, right? Corporate India की balance sheets बहुत ज़्यादा deleveraged हो गई हैं, debt weight level बहुत कम हो गया है, right? Let's say, as of now, I mean, people can have a different view. As of now, there is a 99% chance. That's what we are taking confidence with, that we'll have a stable government in May or June of next year when the results are out, right? So once that 99% becomes 100%, was political stability factor. Then there is a this 22 is also 22 को भी cross करने का there will be a scope to improve even there onwards. Next, please. Yes, I think the last two slides. ये बहुत बार हमारे सारे colleagues, Raj, Rahil, Mayuri from the Mumbai team, and Merlin, and all of them beautifully explain in Informed Investor, even in different forums, including Sanjeev's, but still long-term focus, fundamentally driven, because we have a good 9 member research team who does day in day out. Obviously we have a quant engine as well, wo hame thoda timing mein help karta hai. Very important, please look at a portfolio level, right? Today we are happy that Team India has gone unbeatable so far, right? ठीक है, हमें वो भी खुशी है कि कोहली ने इतने रन बनाए, रोहित ने उतने रन बनाए, बुमराह उतने विकेट लिए, बट लार्जर खुशी तो ये है ना कि इंडिया अभी तक बहुत अच्छा प्रोग्रेस कर रही है, राइट? तो जस्ट लाइक दैट, पोर्टफोलियो लेवल पे क्या हम प्रोग्रेस अच्छा कर रहे हैं क्वार्टर आफ्टर क्वार्टर, ईयर आफ्टर ईयर, वो फोकस रखना है, राइट? नॉट कि 4 स्टॉक इस महीने 10% डाउन है, another 4 are down next month. And we sweat a lot because of that, right? 25 stocks के portfolio में कोई ना कोई नीचे जरूर जाएगा, and that's how a portfolio is done, right? You cannot have a portfolio of stocks which is going up parallelly month after month, quarter after quarter. Whoever claims to have built such a portfolio either is lying, or it's just not possible. A staggered buying, well known, and what we also do is we try and have that mix of bottoms up and top down, so that there is a good confluence there. Next, please. Yes, this is just all of but just the larger focus trends. What we are trying to convey here is that the EPS growth is पे ज़्यादा ध्यान रहता है, right? So let's say in that, so there is a journey of we have given 3 bars, the right side bar 3, 4, 5 times. Let's say we focus on the 4x right, which is nothing but 32% compounding. The larger focus trends, what you will notice here is that we are trying to have a portfolio which is where the earnings is about 24% or more, right? Balance, which is the maths part, the art part, which we try to leave it to the market, and obviously it is a very important function. PE re-rating, वो येलो बार है, दोनों का एक अच्छा संगम होता है तो वो 32% कंपाउंडिंग आ जाती है. Again, this is not going to be linear. There'll be years when it'll be 12% portfolio growth. There'll be years when it'll be 24%. There'll be years when it'll be 44%. There'll be years there'll be 64%, right? There'll be a year, one off year where it'll be flat or minus, right? But over a period, can it potentially grow at 32% CAGR? The answer is yes, at a portfolio level. And left, maybe again we are having that buckets which all of you know, structural growth, which is the way I call it, is my the dal, I mean the roti, the chawal, the sabzi, and the curd. The business momentum is what I will call my soup, salads, and the starters, right? Because this is thoda momentum, soup of the day, salad of the day. It's more in momentum. हर चीज का एक role है portfolio बनाने में. That's the way we have our meals. And the circle of opportunity is more like your drinks and your the first thing and the which we relish and the dessert section, right? उधर कहाँ पे ऐसी opportunity है, which we obviously try and have that. We don't, I mean, at least I don't end up having the same dessert every time you go out. You try to have that आज कहाँ कौन सा अच्छा dessert है, you try and have that look at that pastry section, कौन सी अच्छा लग रहा है. So here also we try and look at market में कौन सी वो stock है which can give us that circle of opportunity, and together we can make a sumptuous a buffet which can be laid out for our investors, which can help them in that journey of long-term wealth creation.
Well, you heard it from the experts. So I'm going to leave you with just that. This is Raj Mehta signing off, wishing you and your loved ones the very best.
Did you like watching this video? Then download our app Informed Investor to watch more such informative and interesting videos.